With world-class expertise and local insight, Dexus creates value, not just for today, but long into tomorrow.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB. I'm Andrew Gagan. Great to you can join us as we round out this week. And what an end it's been. The SIBO 200 there looking as though it's going to finish about 1.1% higher. Similar gains there we're seeing on the ASX 200. And it really got a boost along by the prospect of some China saying it's open to trade talks with the US. So clearly investors seeing a glass half full at the moment as far as those tariffs are concerned. That just takes us to our themes of the day, those trade talks. So we're waiting on news from the US, I guess, when they're going to approach China to begin those trade talks. Banks build. Yet again, we've seen those the financials lead the way on the local share market. The CBA hitting another record, quite amazing given where we've been over the past month or so. And election day, yeah, we are election eve, of course, today, tomorrow, and by, well, in about, let's say 36 hours time, we should know the result of the election. Will it be a clear result? Will it be a hung parliament? Maybe a minority government there? We shall see. All right, a quick look at the sectors that have moved today. I mentioned the banks leading from the front yet again. That's ahead of, we're going to get their half-yearly updates next week, aside from the Commonwealth Bank, but we'll hear from ANZ, NAB and Westpac, all rising along with Macquarie Group as well. The miners also in the green today, led by some of the larger miners there. The gold miners tipping back into the green for the first time in a few sessions. And tech managing to move higher, aside from Zip. And look, a very negative movement today from Block. We saw at one stage it was down 33%, all over the concerns about the US consumer and the effect of those tariffs it's having on those buy now, pay later stocks in particular. Quick look at the top stories. WiseTech confirming media speculation it's considering the acquisition of E2 Open in the US. Corporate travel management echoing Flight Centre and flagging subdued revenue outlook. Helia posting an increase in first quarter statutory net profit despite lower insurance revenue. And Capstone Copper reiterating its guidance after increasing production by more than 17% in the first quarter. And computer share slipping, UBS downgrading it to a sell on valuation risks. Judo Capital extending declines on weak outlook, and it's reached its lowest level since August last year. Well, let's welcome back Shane Oliver from AMP. Shane, we missed you. We missed a couple of Fridays, obviously, due to Easter and Anzac Day, but good to catch up with you again. Let's first start with China and the US. So we did see those market response too, with China saying, look, it is open to talks with the US.
Yeah, that's very good news. And I think we were going to be up today anyway. We were certainly up ahead of that news as the rebound continues. And that's mainly on the back of Trump sort of going backwards on his tariffs. But the news on China is quite good. This is the first time they've acknowledged that the US has approached them. There were Bloomberg reports and other reports around that the US had put out feelers to China, which is, of course, contrary to what they've been indicating in the first place. Trump and the White House press secretary said it was up to the Chinese to contact them. But I think the US side was getting very nervous here, and they decided they should contact the Chinese. Now the Chinese are deciding what to do. You've got to be a little bit cautious about it, though, because there's a long way to go in relation to all of this. The Chinese appear to be demanding that those reciprocal tariffs, that the tariffs be removed off China before the negotiations can start. If that's the case, then there might be a bit of a sticking point. We might be waiting a while before these negotiations actually get underway. But in any case, it is a positive sign. My feeling remains, though, that this rally we've seen in markets, well, a good one, and it certainly indicates that there is pressure on Trump, is a constraint on Trump, that financial markets still have sway over Trump. But by the same token, there is a risk that the markets have gone too far, too fast, that he can pivot back to being more aggressive. He might take the rally in markets as a sign to get more aggressive again. He might feel emboldened again to say, well, everything's okay. I can go back to getting aggressive on tariffs again. So I think it's way too early to say that the worst is over here. And we're yet to see the full impact of his these flip-flopping and heavy tariff announcements on hard economic data. And I think that's yet to show up in the weeks and months ahead, particularly in relation to things like jobs in the US, consumer spending and so on. And that will unfold over the next few months.
So Shane, as you say, still a long way to go. And we're only just over 100 days into the Trump presidency. So how would you sum up those first 3 months? There's a lot to consider.
Well, I think it's been a rollercoaster ride. It started with extreme optimism that Trump would focus on more Reaganite type policies, tax cuts, deregulation, and the tariffs would take a backseat. Share markets went to record highs in February. And then, of course, when he started announcing the tariffs and the news there came thick and fast, and it ultimately ended up being far worse than anything he'd flagged in the election campaign. Don't forget, in the election campaign, he talked about 50 to 60% tariffs on China, not 145%. He talked about 10 to 20% tariffs on places like, or the rest of the world, but some of those tariffs on the rest of the world were way in excess of that. So that then caused that huge fall in markets, worries about recession, worries about the safety of the US as an investment destination, worries about the reserve currency status of the US dollar. Then, of course, he backtracked. He got nervous, he got yippy, his team got yippy and nervous, and then markets have rebounded, recovering more than half of their losses, including our share market. We never fell as much in the first place, and we're recovering very nicely. But that roller coaster ride, I think, will continue. And my colleague, Mi Bu, who you might be speaking to in the next little while, put together a fantastic chart looking at the correlation between the first 100 days, shares are down still in the first 100 days of Trump's presidency, and what happens over a president's full term. And there is a positive correlation there, and the fact that they are down in the first 100 days maybe doesn't augur well for the rest of his presidential term. And of course, there's 1,360 days or so to go. So that's not necessarily a good sign. Ultimately, though, I think Trump will have to back down and pivot to more positive policies. And then you see central banks cut rates, and then you can expect more positive reaction in markets. But so far, it's been a bit rough. I think far rougher than was anticipated on January the 20th.
A bit rough, might be an understatement there, Shane. Nonetheless, let's turn to our own backyard then. And but we did get that quarterly read on inflation during the week, obviously trending in the right direction. How are you viewing what the RBA is likely to do next?
Well, I think they're likely to cut. That was our view before the inflation numbers, and it remains our view. Those numbers were fractionally higher. The headline was actually a little bit lower than the RBA's forecast. The underlying number, the trim mean, was in line with the RBA's forecast, but slightly higher than we in the market were looking for. So it came in at 0.7%, 2.9% for the year. We were looking for 0.6%, 2.8% for the year. But whichever way you cut it, it is coming down. It is back in the target range. If you average the last 6 months, it comes in around 2.5%, 2.4% to be precise, which is good news. And I think you could also see clear signs there that services inflation is slowing down. If you look at market sector inflation, it's down around 2%. So all of these things, I think, are consistent with the Reserve Bank having scope to further cut interest rates, particularly given that monetary policy is still tight and you've got this threat to growth from Trump's tariff. So we think we will see a 25-point cut in a couple of weeks' time, and there'll probably be another one in August, and maybe one more before the end of the year. But by early next year, we're probably going to be seeing the cash rate down in the low threes, maybe 3.35, could be as low as 3.1%. So more to go in terms of rate cuts, but it's going to be a gradual process. Today's retail sales figures, though, did highlight that consumers are still struggling. They're still desperately dependent on sales activity or discounting, which boosted things in the December quarter. Things fell back again in the March quarter. I think that recovery in retail sales can continue, but it does need more rate cuts.
Yep, well, cost of living certainly a factor as far as the election is concerned. That will be resolved tomorrow, Shane. What of the prospect potentially of a hung parliament or minority government? How are the markets, do you think, likely to react to that?
Well, probably negatively. I think if Labor is returned with a majority, or we swing to the coalition with a majority, which seems unlikely. The coalition would have to win more than 22 seats or something like that. Seems unlikely, but either of those outcomes would be taken fairly neutrally by the market. The market might think, oh, it's out of the way now, so that's good. Might be slightly better gains if the coalition wins because they're traditionally seen as more market friendly, more business friendly, but not a lot in that. The main response would come if it looks like it's going to be a minority government dependent on the Greens. I think the prospects of a Liberal government dependent on the Greens are next to zero because the Liberals wouldn't get into bed with the Greens, so I think it's very unlikely. Although apparently I heard on Q&A the other day that Tony Abbott did try and get Adam Ban over the line several years back, but that seems unlikely. The more likely scenario would be, coalition, say Labor loses a few seats. If they then have to go with the Teals or other independents, I don't think that'd be bad for market. Market would think that's business as usual. If alternatively they lose so many seats and the only way to govern is with the Greens, markets would take that badly because the Greens is seen as less business friendly. They would be seen as dragging Labor to the left. Then you could see a negative reaction, slightly higher bond yields, slightly lower share market and Australian dollar. And ultimately the market would then wait to see what the full impact is and how far left Labor would have to go. But that would be the main way you'd get a reaction here. Current polling does have Labor ahead around the same degree to the extent to which they were back in 2022, but we know it's all going to come down to the marginal seats. But if they lose a few seats, just lose their majority and then depend on the Teals to get back in or others, apart from the Greens, then I don't think the market would be too concerned.
Shane, enjoy your democracy sausage tomorrow. Thanks for joining us from AMP.
I certainly will.
Shane Oliver from AMP. All right, let's take a look now at stock of the day. It was blocked. We were talking about that earlier, given how far it has fallen. The Afterpay owner missing estimates of first quarter earnings amid muted consumer spending, setting its US and ASX listed shares lower. Adam Dawes from Shore & Partners and Howard Coleman from Team Invest consider it.
There was an issue around debt repayment and the amount of convertible notes that they've got coming up in the next 2 to 3 years, a couple of $1 billion. They did talk about how they're not going to be able to repay that debt as well, or they're going to need to find some more funding for that. They've got rolling credit lines. With all of these businesses, buy now, pay later businesses, it's a bank's nirvana as far as that they're always going to need more credit, they're always going to need more capital, and they're going to continue to keep getting that capital moving forward.
Every time unemployment rose, bad debts rose dramatically. It wasn't just in proportion to the amount unemployment rose. When employment was high, you collected your funds with a piece of cake. When unemployment rose, not only did it cost you more to collect because you had to have more workers doing it, so your internal costs rose, but your collection percentages dropped. So you had higher costs, lower revenue. So, adding that to what Adam had already, I think, said very well indeed, I'd say it's a sell as well.
Let's turn to the market leaders and losers at the moment as we round out this Friday and the week, of course. Taking a look at that list. Do we have that up there? Well, let's start with the laggard, shall we? Block among them, given what we just reviewed there, down some 27%. Corporate travel also out with a warning there. Zip following Block, but obviously not nearly as severely there, down 5.5%. Web travel similarly with corporate travel and computer share also being hit today. On the positive side, Clarity Pharmaceuticals, those uranium stocks doing well, continuing the volatility we've seen in that particular sector. Neuron Pharmaceuticals having appointed Daryl DeCask as Chief Regulatory Officer. Telix and Nickel Industries also on that list. Quick check of what's on overnight. We get the unemployment rate and PMIs from, well, that should be the US Also the unemployment rate with the, we get the non-farm payrolls out tonight in the US. It is election day tomorrow, of course, locally, and ahead next week. In fact, we'll be analysing that election result on Monday. We'll get building approvals on March on Tuesday, the US FOMC rate decision. Wednesday, that's Thursday our time, along with the Bank of England and China's international trade for April. Quick recap of where we're ending, about 1.1% higher on the SIBO. Similar moves there we've seen on the ASX 200. That is the COB. Thanks for listening and watching. We'll do it all again next week.